In the world of real estate, a hurricane is brewing, and it's far from your typical weather forecast. Welcome back to The Elite Economizer, where we dissect the complexities of the real estate market to help you navigate the storm. I'm your host, and today we're delving into insights shared by one of the industry's most prominent figures, billionaire real estate investor Barry Sternlicht. Imagine the real estate market as a Category 5 hurricane, dark clouds hovering ominously, a blackout over the industry. It's a scenario that's sending ripples of concern throughout the sector. But before we dive deeper into the eye of the storm, make sure to hit that subscribe button. Our mission is to make you a better investor by gleaning wisdom from the world's greatest minds. Barry Sternlicht, the co-founder, chairman, and CEO of Starwood Capital Group, has raised a hurricane alert. Starwood Capital Group is a real estate giant with over $120 billion in assets under management. When Sternlicht talks, investors listen. So, what's causing this financial tempest? To comprehend the hurricane, we need to grasp the intricate relationship between real estate values and interest rates. Real estate generates a fixed income stream and a predictable cash flow over time. As interest rates rise, the value of these income streams declines. Let's illustrate this with an example. Consider owning an apartment building generating $100,000 in annual cash flow. When interest rates remain low, the building's value remains high. However, as rates rise, the value diminishes, affecting potential returns for investors. But why the impending hurricane? According to Sternlicht, a recession is on the horizon. The Federal Reserve's efforts to slow the economy down have impacted real estate values, with yields on properties rising due to higher interest rates. A credit crunch is looming, and the industry seeks relief and a clearer understanding of the Fed's long-term plans. In the world of real estate, supply and demand dynamics are pivotal. The value of properties depends on these forces. During the past few years, a strong economy, low unemployment, and government stimulus programs bolstered demand for apartment units, driving up rents and property values. But during a recession, this equation reverses. One segment feeling the hurricane's impact is the office market, particularly C-class office buildings. With remote work on the rise, many companies require less space. This leaves C-class properties empty and in some cases, destined for demolition. The A-class buildings, however, remain attractive, ensuring their continued occupancy and profitability. Remote work isn't just affecting the office market. It's also altering the demand for office space. Companies are adapting to a flexible work week, with most employees no longer keen on a 5-day office grind. The rise of AI could further disrupt industries that traditionally relied on office space. Meanwhile, the housing market faces its own challenges. Despite rising interest rates and soaring home prices, the supply remains limited. People are reluctant to sell due to golden handcuffs, causing demand to outstrip supply. However, this may change as rates fluctuate. Housing affordability in the U.S. is at a historic low. High home prices and increasing interest rates have made home ownership more challenging for the average American. While rising interest rates should logically lead to falling home prices, the market is currently experiencing a phenomenon where homeowners are reluctant to sell. So, what's the outlook? Barry Sternlicht's forecast is a rough patch ahead, but he hints at opportunities beyond 2025. Surviving the financial hurricane may be the key to unlocking these prospects. Make sure to subscribe to our channel for more insights that can help you weather the storm. To navigate this real estate hurricane, it's crucial to understand the intricacies of the market. The financial storm brewing is not just about numbers, it's about people, their decisions, and the interplay of various economic factors. Let's delve deeper into these aspects to better prepare ourselves for what lies ahead. Interest rates are at the heart of the impending real estate hurricane. Inflationary pressures and economic policies have pushed the Federal Reserve to raise interest rates to curb the economy's overheating. While this is a necessary step to prevent runaway inflation, it has far-reaching consequences for real estate. Historically low interest rates have driven up real estate values over the past decade. Investors flock to real estate assets seeking higher returns than traditional fixed income investments. This surge in demand led to an increase in property prices and consequently, rental incomes. As interest rates rise, the value of fixed-income investments like real estate tends to decrease. The underlying logic is simple. When safer investments like government bonds offer higher returns, real estate assets must provide competitive yields to remain attractive. These dynamics put downward pressure on real estate values. However, it's essential to distinguish between market fluctuations and the underlying fundamentals of specific real estate asset classes. In the United States, some sectors, such as the apartment market, industrial and logistics properties, and even the hotel industry, have maintained strong fundamentals. For example, the apartment market has benefited from increased demand as rising home prices have pushed more people into renting. In some regions, vacancy rates are low and rental incomes remain steady. But this isn't the case for every property type or location. The office market, as mentioned earlier, is undergoing a significant transformation due to the rise of remote work. While A-class office buildings in vibrant, desirable locations continue to thrive, C-class properties in less convenient areas are struggling to find tenants. The pandemic accelerated remote work trends, and many companies have realized that a significant portion of their workforce can function effectively outside the traditional office environment. This shift in demand has left landlords of less attractive office spaces grappling with high vacancies and diminishing rental incomes. Sternlicht predicts a bifurcation in the office market, where high-quality office spaces thrive, while less appealing spaces face challenges. Cities with difficult commutes like New York and Los Angeles are experiencing more significant impacts on their downtown office markets. Remote work has become a defining feature of the post-pandemic work landscape. Many employees no longer want to be in an office 5 days a week. This shift in work culture affects not only the office market but also various sectors that traditionally relied on office space. The rise of remote work is expected to reduce the demand for office space in the long term. Companies are reevaluating their office space needs, adopting flexible arrangements, and even considering downsizing their physical footprint. Sternlicht notes that even Amazon HQ2 expects employees to be in the office only 4 days a week. Additionally, advancements in artificial intelligence, AI, are expected to further disrupt industries that rely heavily on office space. As AI becomes more integrated into business processes, it may reduce the need for physical office presence in sectors such as customer service, data analysis, and routine administrative work. Shifting our focus to the housing market, we encounter a different set of challenges. Despite rising interest rates and soaring home prices, the housing market remains a puzzle. Housing affordability has reached near historic lows, leaving many prospective homebuyers in a precarious position. Home ownership dreams have become increasingly out of reach for the average American. High home prices are a significant contributor to this affordability crisis. The median sale price of a house in the U.S. reached a staggering $416,000 in June. This represents a substantial increase from $315,000 in June 2018. However, it's not just high home prices that are making home ownership difficult. The recent surge in interest rates has made it more expensive to purchase a house using a mortgage. As interest rates climbed from the historically low levels seen at the beginning of 2021 to as high as 7%, monthly mortgage payments increased significantly. A mortgage that once had a manageable monthly payment of $1,478 at a 2% interest rate would see that payment jump to a daunting $2,661 at a 7% interest rate. This dramatic increase in the cost of borrowing has strained the budgets of potential homebuyers. One intriguing phenomenon that's emerged is what some experts call golden handcuffs. This concept refers to homeowners who are reluctant to sell their current properties because doing so would mean losing their low interest rate mortgages. Many homeowners locked in historically low interest rates during the pandemic. Selling their homes would require them to secure new mortgages at higher rates, resulting in increased monthly payments. This reluctance to sell has contributed to the limited supply of homes available for sale despite rising prices. Supply and demand dynamics play a crucial role in shaping the housing market. When demand outstrips supply, it puts upward pressure on prices, making homes less affordable. During the past few years, a combination of factors, including a strong economy, low unemployment rates, and government stimulus programs, led to increased demand for apartment units. This surge in demand pushed rental incomes and property values higher. However, the looming economic challenges could disrupt this trend. A recession often leads to a decrease in demand for apartments as people face job losses and financial difficulties. During a recession, some tenants may be forced to move in with family members or roommates to reduce their housing expenses. This could lead to an increase in vacancy rates and a decrease in rental incomes for apartment building owners. Additionally, landlords may face eviction challenges as tenants struggle to meet their rent obligations. Furthermore, economic downturns often lead to increased supply in the housing market. Construction projects initiated during times of economic optimism may reach completion during economic downturns. This increased supply could put additional downward pressure on home prices. So, what does this real estate hurricane mean for investors and homeowners alike? Barry Sternlicht's forecast suggests a challenging period ahead with economic turbulence likely over the next 12 to 18 months. The economic storm may create hardships for many, but there may also be opportunities on the horizon. Surviving the hurricane and making informed investment decisions could position individuals and businesses to capitalize on these opportunities. While the storm clouds may seem daunting, they can also bring clarity and change. Some real estate segments may undergo a transformation, with office spaces adapting to the new normal and housing markets adjusting to shifting demographics and economic conditions. To navigate this real estate hurricane, it's essential to remain informed and flexible in your investment strategies. Here are some key takeaways to consider. Stay informed. Keep a close eye on economic indicators, interest rate trends, and local real estate market conditions. Knowledge is your best defense against uncertainty. Diversify your portfolio. Consider diversifying your real estate investments across different asset classes and geographic regions. A well-balanced portfolio can help mitigate risks. Assess property quality. If you're investing in office space, prioritize high-quality, well-located properties that are likely to withstand market shifts. Closely monitor the demand for these spaces. Monitor remote work trends. Stay attuned to developments in remote work and AI technologies. These trends could impact the demand for office space and the types of properties in demand. Evaluate housing market opportunities. Keep an eye on the housing market for potential buying opportunities. As interest rates fluctuate, some homeowners may decide to sell, increasing supply. Financial preparedness. Ensure your financial situation is robust, with contingency plans for potential economic downturns. Having access to capital can be a significant advantage during turbulent times. Thank you for joining us on this journey through the real estate hurricane. Remember to like this video and subscribe for more valuable content. Together, we'll navigate the complexities of the real estate market and emerge stronger on the other side. Stay informed, stay resilient, and stay safe.